Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, Enlightened investors. Welcome, and I'm delighted that you are joining us for the launch of our new podcast, Real Estate Investing Abundance. 3 times each week, we will bring value bombs of investment wisdom from the most successful and renowned experts in the industry. The focus is on passive investment in real estate to help you as our listeners develop financial independence to live life abundantly. If you enjoy the show, please take a moment, find us on Apple Podcasts, and leave us a review. Reviews are vital to growing our audience so we can help more people find their avenue to financial freedom. Each week for the first 4 weeks, we will do a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. So please go to Apple Podcast and leave us a review. Enlightened investors, happy to be back with you again today. I'm your host, Dr. Alan Lomax. If this is your first time tuning in, I know you'll find great value in the show. Are you perhaps a busy professional, passionate about the work of your calling, but have come to realize that the hope of developing financial independence has taken a backseat to other priorities? If you can identify, then I have good news. SteveTalker.com is an investment company designed for passionate, fulfilled professionals like you to help you develop financial independence built on solid, passive real estate investments. I created Enlightened Investor Circle just for you. So go to our website today and enroll, and there you'll receive education and support for your passive real estate investing goals, no matter what level of expertise or experience. Today, we continue our series of superstars from our previous podcast, Creekside Chats with Successful Real Estate Investors. Today's superstar is Lane Kawaoka. He started out his investing career while living in Seattle and working full-time as a civil industrial engineer. After learning the difference between cash flow investing and appreciation investing, he shifted his investments to the South and the Midwest. Today, he invests nationwide in multifamily apartments, mobile home parks, and assisted living. Currently, he holds over 4,500 doors. And today, Enlightened investors, let's welcome Lane back to the show. So, Lane, before we get started, tell us about a memorable experience from your formative years that helped you to be the person you are today.
I remember when I almost got fired, and after working for a company for 8 years and then being put in a position where, maybe they don't want me here anymore. And I never wanted to be feeling in that position again. Luckily, I hadn't been investing for several years prior to that point. So I already knew the answer in the back of my head was to continue investing in my real estate so I could eventually fire my boss. But never want to be in that position again. Never want to have only that one sole source of income.
Yeah, it's a vulnerable place to be. A lot of us, I think, have found ourselves in that situation, and it is not fun. Lane, I understand that you are not a particularly big fan of Susie Ormond and David Ramsey. Both have huge followings, so why the contrarian view?
Yeah, I think they're good people, and their advice helps out a lot of people and helps out the masses. But for a lot of folks that kind of like myself included, working professionals, I think a lot of your audience, we're a lot different than most people out there. Most people out there are financially immature. They spend money more than they make. And whether they have a high salary or not, they're not financially mature. And when I'm financially mature, I'd say most of my investors today with their professional salaries are able to save at least $20,000, $30,000, $50,000 plus per year. So that's their income minus all their daily expenses, vacations, etc. Now, I don't know what the percentage is. 80 to 99% of people are not that case. They're not like us. They're not listening to podcasts, feeding their mind and putting their money to good investments. And I think that's where the Susie Ormans and the Dave Ramseys of the world, they cater towards the masses that have difficulty controlling their spending and basic financial well-being. But for the rest of us who are able to generate capital, it's better for us to invest. So there's a paradigm shift between these two. And it's not like I don't like them. The advice is that you shouldn't listen to these guys. It's a paradigm shift of what you should listen to if you are one of these financially mature folks out there.
Talk to us a little bit about the fiduciary rule for financial advisors, because I don't think a lot of people really understand that most financial advisors out there are not fiduciaries, but then I don't think a lot of people even understand what a fiduciary is. So talk to us about that whole paradigm.
The fact of the matter is nobody really knows what the term fiduciary responsibility, but the way the system is created is you have financial planners who sell investment products. And these are retail products that are laden with hidden fees. You can forget if the thing says expense ratio. It's not counting all these other hidden fees. So you can think of it as above the line expenses that ultimately come out of the investor's pocket. So when I was investing in real estate, my first rental property, I was making like 20 to 30% on my money. When you combine the cash flow that you're making every month, the tenants paying down your mortgage for you, so you're having an equity build up there, the tax benefits, and the appreciation using leverage. That's how you're getting those high returns. I think if people don't believe me, I have a little video where I do a whiteboard exercise. For now, just take my word for it. If you don't believe me, go check out the video, simplepassivecashflow.com/returns. Check it out. But then this is very early on, I was like, why am I going to put my money in this 401k mutual fund thing at 8 to 10%? This makes no sense to me. If I can just do it on my own, 20, 30% plus, why would I want to do this? And then I started to discover this whole system, right? The system wants us to put money into Wall Street so that Wall Street can extract all these fees. How else are these high executive salaries? And how else do they have these big buildings out there? They're not doing this stuff for free. A bank at every corner in America that's a nice building doesn't come free. They're running a business. And I think and it trickles down to the financial planners or the individual salespeople. So when you go into retail investment products, you're going to be paying a high fee, whether you see it or not, or whether it's disclosed or not. Just like when you go into Neiman Marcus or Nordstrom, there's a higher markup for it. Now, people may like shopping. I personally do not. I'll typically just buy it on eBay or buy it on Amazon or go to Walmart or go to Macy's for comparison in terms of department stores. But these fee-laden products are retail products. And unfortunately, this is what the average working professional is served up. And it's compound with the fact that in these retirement programs, which I'm not a big fan of retirement plans, you think of it like a cafeteria. When you're in your 401k, you're only subject and have choices to go to these different cafeteria options. And to take the analogy another step forward, we all went to the cafeteria when we were in high school. We're captive to the crappy food and the higher prices, or at least it was at my private school. But once you get that off-campus pass, you're out of there. You're going to Taco Bell, Burger King, McDonald's, and that's not the greatest food. But at the time, good tasting, cheaper, more choices. And that's what is the same as investing outside of your retirement, going out and going into your own deals or going directly with the sponsor in some syndications or private placements and getting outside of the retail market, or in this case, the cafeteria.
Yeah. I didn't really realize until actually going to your site and looking into the blog post that you had done in conjunction to financial advisors, that financial advisors are not fiduciaries. As a realtor, that really surprised me because realtors have to take an ethics class every 2 years, at least here in North Carolina. And part of that is reviewing what our fiduciary responsibility is to our sellers and to our buyers. And it really was surprising to me to find out, because I really have never done any investing in Wall Street, to find out that most of these financial advisors are not fiduciaries. They have no fiduciary responsibility to their clients. Now, there are some financial advisors out there who are in various different organizations where they do have a financial fiduciary responsibility to their clients, but they are few and far between. And that was surprising to me. We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer 773-491-3145 or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn.
I guess in terms of fiduciary responsibility, there's different degrees of it, right? Like in the spectrum where I do believe like doctors, I feel like they take that whole oath, and I think that they want what's best in terms of the patient at the end of the day. Of course, things are getting harder and harder for them in terms of what is insurance and on what is the cheapest way that the patient can afford. But for the most part, I think they're doing a pretty damn good job at keeping that fiduciary responsibility. Realtors are okay about it. They might be halfway in the middle, but financial planners, it goes out the window. And you did mention so people who are a little bit smarter than the average cat, probably a lot of the listeners here, right? Probably saying, Alan, Lane, like there are fiduciary financial planners out there that are more fee-based, right? You pay them a sort of a salary or a commission percent AUM, assets under management, which is you get on their calls, they're always like AUM because that's how they get paid. They take a percentage, and supposedly they don't usher you into that mutual fund of the week where they get like a 4 or 5% commission rate off of. But you can't tell me that they are totally turning a blind eye and putting you in the right investments that are just because they're not going to get that fee. And some people will even take it a step further and say, no, they're not allowed to take those commissions. You're still paying them for a role, and you're still going into retail type of products where maybe not that salesperson is getting commission, but the agency house is taking a heck of a lot of fees. And these can be expense ratios, transaction costs, which is usually like 1.4%, tax costs, cash drag that they're tacking on their advisory fees, not with the financial planner, but with the agency house for in-house staff. How else are they paying these guys to run these things for you? It ultimately just comes out of your pocket.
Yeah, absolutely. It's not necessarily even going beyond this aspect of their fiduciary responsibilities. By and large, they just don't know of any investments outside the cafeteria lineup. That's what they're trained to sell. That's what they know. And so that's what they're going to advise all of their clients into, whether or not it's the best investment for them or not. They only know the cafeteria lineup, like you were talking about earlier. The true cost of a mutual fund, most of that cost is hidden, but you had mentioned a few things. There's the brokerage commission, the market impact, spread cost, tax cost of 1 to 1.2%, cash drag of 0.83%, soft dollar cost 0.4%, and then of course there's the advisory fees of anywhere from 0.25% to 2.5% or more. I don't know what a cash drag is. Tell us, what is a cash drag and what is a soft dollar?
I don't know what that thing is either, but they just throw it in there. At the end of the day, when you add these things up, you may be talking maybe 3 to 5, 6%. Doesn't sound like a much, right? But when your total returns are like maybe 10%, that's a huge chunk. That might even be half at the end of the day. And this is the difference between why the proof is in the pudding. If it takes most Americans 40, 50 years to hit that retirement threshold, but it takes an alternative investor 5 to 10 years is what I see. Let's get out of the numbers. The proof is in the results, right? And one rule I've always followed is never take financial advice from those who are not financially free. And it definitely isn't the financial planner. The only way they're making money is commissions off you. That's an active business. I'm not going to listen to them. And I'll even take it a step further, right? Like I train a lot of people to understand that your CPA is not a planner. You should not go to your CPA for strategy. That is your job as the investor. This is your job to empower yourself and get educated and then tell your CPA what to do. If they knew what to do, they'd be out of the day job. That's why they still have a job. They have to go to it every single day and trade time for dollars. You have to find people who've already figured it out gone in escape velocity, gone financially free, zero dream, whatever you want to call it, and have escaped the rat race and figured it out and are no longer trading time for money.
Talk to us about how these commissions work, because when things are good, they're going to take a fee when the stock is sold or traded. But when things are bad, they're going to do the same thing, whether good or bad.
They win, right? Win or lose, they booze. But that's like, they don't have any carried interest, right? Like, and in like syndication deals, ideally you want to be aligned with the sponsor via carried interest. So the sponsor doesn't get paid unless the deal goes well, where you, the passive investor, are getting paid as well. Not the case in Wall Street world.
Yeah. REITs are a real estate investment, and yet it's a Wall Street investment. So talk to us about REITs and how they work.
Yeah, people will say, yeah, I listen to this podcast, I hear a lot about like real estate, and you get it, right? Like, I want to invest in real estate, I'm going to do a REIT. But the trouble is, yes, REITs do invest in real estate. However, two things. First, they are retail products, fee laden, right? At the end of the day, you're not going to grow your money very much. And the investments that they go into are very conservative, which can be a bad thing. They're just made to hold their value, be conservative. A lot of times we'll sell our assets to REITs because they're not looking to do any value add strategy. They're just looking for a stabilized asset. Sometimes we'll even buy from REITs their apartment buildings, because REITs are funny animals. They don't necessarily do what's best for the investors. They do what they're designed to do is create a stable yield so they can keep that load fee. That's how they make their money, with these fees. So like, one strange rule that I realized, like with REITs, is that they're supposed to pay 90% of their earnings out to investors, which sounds good from the surface. What if they really need to change out the boiler or do a new facelift on the property that would require those cash reserves to be held and put into the asset to give it more life, to make more money in the future? That is something that a REIT is not able to do. They are created with that prospectus to go out and pay 90% of their money out. And this is where we find a lot of our opportunities. There'll be REITs out there that aren't taking care of the asset. They're not really having a fiduciary responsibility to the legacy of the asset and the investors. So they have to dump the asset. So it's a great find for us. And it depends what kind of investor you are, right? To me, I would rather be more holistic investing and keep a good asset to in turn make more money in the future.
Yeah, from my understanding, REITs don't, generally speaking, really have a very good cash-on-cash return. If you get 4 to 6% out of a REIT investment, you're usually doing pretty good. Because like you say, the REIT is there to preserve the capital. It's not really there to grow the investment. And if they get a return of 4 to 6%, they're beating mutual funds. And so they're happy with that. Not the best place for investing, as far as I'm concerned. We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet, investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios, selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
Well, Lane, what is it that you invest in, and why do you invest in the assets that you invest in?
Yeah, we've been talking a lot about retail investments. So I definitely do not invest in retail investments. I directly invest in deals that I run or directly with the sponsor in syndications. And that's the first layer to this. We cut out the middle, all of these layers of fees. And in a way, it's like buying like produce wholesale instead of retail, where it goes to a bunch of middle. But in terms of asset class and what I like to invest in, I like the whole workforce housing sector, apartments, mobile home parks. I think in this country, there is a greater demand for workforce style housing. So you're lower middle class. I think in bad times, recessions, you're going to need that demand goes up because the high-end luxury people have to move back into more value housing. The population in this country is improving, and it's a commodity in a way that there's a greater demand for. We try and pick up 100 to 300 unit apartment complexes that are stabilized, 90% occupied or greater. So we can pick up agency financing, long-term stable debt, and we're cash flowing day one. But we usually like to find a deal with a little bit of value add. So maybe adding $4,000 to $6,000 of rehab into every unit, new flooring, new appliances, new playground equipment, paint job. Nothing major, but it's enough to bump the rents up 100, $200 across the board. And we're playing that forced appreciation game. So if we can increase that net operating income, we can greatly increase the price of the building.
And so workforce housing in terms of apartment buildings, mobile home parks, and I also think that you have done some investing in senior housing as well. Is that correct?
Yeah, that's more of a development play. Senior housing, I think a lot of people talk about the silver wave coming, demographics, right, with the baby boomers now retiring and possibly needing or likely needing senior assisted living facilities 10, 20 years down the road, if not already. I'm a little bit, I recognize the need for it, and I don't doubt the demographic need for it, but I recognize that it's a complicated business. I have a lot of investing is finding the right people that you can trust to invest with that are proven. I quite honestly have not found too many people in that asset class that have impressed me. Therefore, I'm still looking. But as far as my passive investment, I'm deploying it elsewhere in a different asset class.
There's a difference also between workforce apartment housing and mobile home housing. What do you find that is different there? What are the pluses and minuses in apartments over mobile home parks and vice versa?
Yeah, so mobile home parks and Class C, Class B apartments, they have somewhat of an overlap. Mobile home parks, I would say, are more technically Class D because your lot rents on those are a little bit lower than $600, $700 on a low end apartment. Some people will be afraid by that kind of clientele, but if you make a nice mobile home park, you attract the best tenants, and that's always the ideal business strategy in general. But like a lot of people live hand to foot, they are making less than $30,000 to $40,000 a year. And the appeal to mobile home parks is they're not making any more of that asset class. And what kind of city council would permit something like that? They've got to be crazy to do that. And I think the biggest thing that a lot of people don't realize is that those mobile home parks don't really make tax revenue for the city or county. So they're going to want to have houses or apartments there or commercial properties so they can extract more revenue. So it's another reason why they're a dying breed, but the demand is there, right? Lower middle class, especially the lower end, there's more and more people in this country born every day, and the wealth gap is just getting bigger and bigger. It's just a demographic demand for that. Apartments in the mid-range. You could even make the argument for apartments in the upper range and assisted living. I think that's the beauty. The tide is kind of rising all boats. People need a place to live, and there's not making any more land. But out of the three, I personally think the most stable right now and the best risk-adjusted return is your Class B apartments, right? Where your clientele, they've got some savings, maybe $500, a few $1,000s in the bank account. They make a decent salary, maybe $40,000 to $60,000 a year, and it's $600 a month to $1,400 for a one-bedroom apartment.
What about 55 plus communities in terms of that and acquiring mobile home parks that may not be that, but turning them into 55 plus? Have you worked with that strategy? Are you familiar with that?
It makes sense in theory, right? I'm not saying that it's a bad idea. I think it's an excellent idea, but it's a pain to do, right? Like call me crazy, but I'm looking for the minimal amount of work and brain damage to extract the most amount of money. Now, I think what you're talking about, that probably will yield more money, but is it worth the squeeze? Like we started to do a lot of small Class C apartments when we first started to do apartments, and we ended up selling a lot of them because the clientele is just a lot of work on our part. I don't really need to do this anymore. I'm financially free. Why bang my head against the wall to extract the extra 10, 20% here or there and take on the operational risk that goes along with it?
Yeah, that has been my experience with mobile home parks, though they do have a very attractive return on investment if they're run properly and you have the right management team. But you are right. They are a headache in terms of management.
Which I think it brings in the whole argument. Like, I think of a lot of our investors come to this, they come to real estate because they owned a handful of rentals. I had 11 of them back in 2015, and that's where I really felt the pinch. No problem. I still have third-party professional property managers helping me. But you start to realize running this on your own is not scalable, right? Where the transition for especially credit investors to go into private placements, syndications with professional operators to manage this for you. You know, you could probably make more money as the kids do with these burst strategies where you buy, rent, rehab, repair, but you're taking on a lot of risk and you got to babysit these contractors. It's a young man's game.
And it is not for professionals who are fulfilled and satisfied in the work that they're doing, because it's going to become a full-time job very quickly. Enlightened investors will be right back after this important message. I hope you're finding today's show informative and enlightening, and that you will please take a moment to find us on Apple Podcast and leave us a review. Each week for the first 4 weeks of the launch, we will hold a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. Reviews are very important for growing our audience. Your review will be immensely appreciated and will help others find their avenue to financial freedom. Lane, before we go into our last segment here, tell us how our viewers and listeners can get in touch with you, because I know that on your site you have a lot of educational material that could be very beneficial.
Yeah, they can check out my podcast, Simple Passive Cash Flow Passive Real Estate Investing, on iTunes and Google Play. My website is simplepassivecashflow.com, and people can shoot me an email, Lane at simplepassivecashflow.com.
And we will also have this information in the show notes. Well, Lane, share with us one of your most difficult setbacks in life, and how did you come through that time, and what did you learn from that experience?
Yeah, my first syndication deal, I went in back in 2013. I ended up investing with a shyster that pretty much ran off with the money. I think a lot of times when you're starting out in this world, you don't know who you can trust. And the only way that I've determined or to mitigate that risk is to build a network of pure passive investors and only invest with those who you built up a relationship with that can verify the track record and experience of that operator. There's too often people give empty referrals. Oh, work with this guy. But when you come to find out, the person making the referral aren't even investing in their own money with that individual.
So that was your first syndication experience?
Yeah. So up until that point, I was buying rental properties and I was just doing it on my own. And I started to feel like maybe I should try this syndication stuff out, because you hear about it quite often, but you don't really trust it. Right? There's just a lot of things. You're used to the status quo, just like how maybe somebody right now is used to the cafeteria of retail investments right now. It's working. They haven't dropped to the face of the earth yet. It may not be hitting all their needs. If you're still investing in the cafeteria stuff, you're probably going to be on the 40, 50-year plan. So what I would recommend people do, just like when I was starting out, just buy a rental property. Or if you buy rental properties, go into a syndication deal. Try it out. Try as best as possible to mitigate the risk of investing with a shyster. Build up and always be building relationships with pure passive investors, which is difficult because for going to the local REIA or those free websites with real estate investors, you guys all know which ones they are. Like, it's mostly just a bunch of like broke guys that don't have good paying jobs and they're trying to get rich quick, right? Not until you get around other working professionals, fulfilled professionals, like you said, that are making six figures and above or $500,000 net worth. So you really start to get into the gold. But they're hard to find out there because they're not going to be hours with a bunch of bros who want to invest and flip some houses.
Well, can you give us a little bit of detail about this first investment that you got into? How did you make contact with this person? And how is it that you were not a total and complete novice? How was it that they were really able to pull the wool over your eyes and get you to invest in a bogus deal there?
Yeah, so I believe, and I've chronicled this on my website at simplepassivecashflow.com/fail. Because as we know, we always try and forget our mistakes. It's painful to relive it. So I wrote it down. The details
it's a good way to learn, though.
It's a little shameful, though. Like, I think if I recall, I got their contact from another self-directed IRA company, which these self-directed IRA companies do these things all the time. They give these like empty referrals to investors so they can use their damn self-directed IRA. That's all they want to do. Whether it's a good investment, they don't know, because that's just a salesman, right? And they're not investors. And so I went into the deal, and supposedly they were going to run these portfolio properties for me, or my property for me, and it went okay for 2 years, and then radio silence. So what everybody thinks what happened was they just let the properties go and decay. They never fixed anything. They just took the profits, paid us like a Ponzi scheme, and eventually with the principal ran off with it and eventually declared bankruptcy. And I think one thing that I did do that was good, I didn't invest a huge sum of cash. It was definitely below $50,000. And I didn't pursue legal action because it's not worth it. And I think that's, if you're going to freak out about $20,000, number one, you shouldn't be investing in a syndication. Most people that invest in syndications are accredited investors. But what I tell my guys is don't invest more than 5% of your net worth into any one opportunity. Because what if something should happen? You don't want to bet the farm on any one investment or operator.
Yeah, good advice there. Thanks for sharing that. I know that is an unpleasant experience, but certainly something we can all learn from to move on and do better. Well, Lane, as you have developed a place of financial independence, how are you putting your success as an investor and entrepreneur to work to create universal well-being and abundance for all beings?
I haven't really figured it out, to be honest. I like dogs. Maybe when I have kids and I get that out of the way, then I'll figure out what kind of legacy I want to create. But right now, I'm just trying to rack up the score and trying to get to that threshold where I can make a bigger impact. Money's not everything, but it gives you a platform. And right now, I'm just trying to grow it as best as I can while the getting's good. Well, these assets make sense today. But yeah, at some point, a lot of my students, they try and create some kind of foundation. The goal is to get up to $4.5 million net worth, because at that point, if you have kids and they're not the smartest tools in the shed, they can live a successful life with what you've created. It can decay. But I think what most people realize, and I realize this, I just haven't figured out where to focus it, is you want to create some kind of impact in life. If this is a minority of people that have hit that $4.5 million threshold. If you hit that threshold and you just want to live out your final days in first class and travel the world, look, I have no problem with that. But for some people, they think that's a little boring and they want to take the platform that they've been giving, hit that 8-figure mark and give back in some way. I just haven't figured out what I want to do yet.
Yeah. In terms of you're a young man and haven't started your family yet, you mentioned the fact that you may just have a child who just doesn't really have that much ambition. But having children is a challenging thing, and not an insignificant number of people have ended up with special needs children. Most people who end up with special needs children are reliant on the government in a number of significant ways, because special needs children take special financial considerations. And you're doing the right thing in developing a platform, because you never know what's going to happen when you become a parent. Well, Lane, imagine that you have come to the end of your life, and I hope that's a long time away. But as you lay on your deathbed, what will you look back on as your greatest joy and sense of fulfillment and satisfaction?
I think that's what simplepassivecashflow.com was all about, a free resource that people could go to, extract some of the lessons, read through the podcast, the articles, the guides. And if they were brave enough and felt inclined to get out of their comfort zone, to start buying some rental properties and scale that up and eventually hit financial freedom, and maybe some of those people would use that platform to create some greater good in the world, to enable people to enable themselves to go out and make that bigger change. That's, I don't know what that number is, maybe 100, maybe 1,000, 10,000 people to get a financial bondage via the information that I disseminate. I think that would be a cool goal to have, what I'd like to feel.
Well, Lane, good goals, and I know you are making a difference throughout your educational programs and through your investment strategies. Well, Lane, it has been a pleasure once again having you on the show, and I do appreciate you being here. So thank you so much.
Yeah, thanks, Alan.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital. a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at steedtalker.com.